All right, listen up, everyone. Settle in. Today, we're going to be tearing down a fundamental habit that, frankly, most of you rely on every single day on this desk. We are looking at a framework that is absolutely going to shatter your reliance on standard net positioning data. So, welcome to this explainer on the gross position trap. Let's get right into it.
Here's our roadmap for this session. First, we'll cover the net position illusion. Then, decoding the four quadrants, spotting internal market conflict, looking at some hard historical proof from 2011 and 2020. And finally, we'll wrap up with gross adjusted position sizing.
Now, before we start pulling apart charts, I really want you to ask yourself something. What if the net position you're trading on is completely lying to you? I know you guys have got years on the desk, you're seasoned, but just consider this for a second. How can a perfectly flat net position actually be hiding a market that's an absolute powder keg?
Which brings us to part one, the net position illusion. Okay, let's dive into this. Imagine two totally different scenarios. Scenario A, you've got 80,000 longs and 30,000 shorts. In scenario B, you're looking at 150,000 longs and 100,000 shorts. Now look at the math. Both of these give you the exact same net position, right? Plus 50,000, but in reality, these represent wildly different market fragilities. Scenario A is just your normal market, moderate engagement. But scenario B, that is massive engagement. Any directional move there is going to force enormous, violent repositioning. The net is identical, but the actual risk, it's literally worlds apart. See, when you collapse two dimensions into a single net number, you are just throwing away critical information. The net position completely hides total engagement, meaning the actual capital committed to the market by both sides. It totally masks internal market conflict, so you're completely blind as to whether bulls and bears are both digging their heels in. And crucially, it obscures true liquidity depth. Bottom line, when you only look at the net, you're flying blind.
Let's move on to part two, decoding the four quadrants.
All right, I need you all to practically memorize this framework. Think of it as your daily cheat sheet. You absolutely must identify which of these four quadrants you're in before you put on any trade. Quadrant 1, that's your bullish consensus. Longs are rising, shorts are falling. You just ride the trend there. Quadrant 2 is the powder keg. Both sides are rising. That's when you prepare for a breakout. Quadrant 3 is your bearish consensus. And Quadrant 4? That's the great unwind, where both longs and shorts are falling. Listen to me. If you're in Quadrant 4, there is no trade. The market's dead.
Let's contrast those two extremes really quickly because it's super important. In Quadrant 2, our powder keg, both bulls and bears are aggressively adding contracts. The net position might look perfectly flat, but the total engagement is surging under the surface. Contrast that extreme danger, that volatility explosion waiting to happen, with Quadrant 4, the great unwind. Both sides are closing contracts out. It's a shrinking, dormant market in pure liquidation mode. Same flat net position on your screen, entirely different realities.
All right, on to part 3, spotting internal market conflict.
So how do we actually track this? Enter your new ultimate barometer, the Gross Expansion Index, or GEI. This measures total capital commitment. We calculate it by taking the managed money gross longs, adding the gross shorts, and then dividing that by the total open interest. This metric tells you exactly what percentage of the entire market is currently engaged. Think of it as your early warning radar for impending volatility.
Now, what's really interesting about this slide is this specific threshold right here, greater than 55%. When the GI hits this extreme level of engagement, the market has officially become a highly volatile powder keg. Any sudden directional move is going to trigger a massive cascade of repositioning, and you are definitely not going to see this level of danger by just glancing at the net position.
Next up in the toolkit is the long/short divergence ratio. This specifically detects internal conflict by comparing the weekly change in longs against the combined weekly change in both longs and shorts. If you get a reading between 0.4 and 0.6, you better be paying attention. It means both sides are building aggressively. Bulls and bears are digging in equally. That is a massive red flag for hidden conflict and usually points to a very violent breakout just around the corner.
Which brings us to section 4, historical proof from 2011 and 2020.
All right, enough theory. Let's look at the actual structural mechanics of past crashes. And this brilliantly illustrates exactly what we've been talking about. Pre-September 2011, the GEI hit an absolute extreme. A classic Quadrant 2 powder keg formed. And then bam, the total gross structure collapsed in a massive wave of liquidation. Fast forward to pre-March 2020. Here, the GEI declined, the market entered a Quadrant 4 great unwind, and then the violent crash happened inside an absolute liquidity void. In both of these cases, the standard net data looked completely normal. But the gross data, It was literally screaming danger.
There is a very good reason they say the GE extreme precedes the price extreme. Just let that sink in for a second. The senior analysts who actually survived the 2011 bloodbath, they didn't just get lucky. They survived because they recognized the gross extreme way before the price broke down. They saw that total engagement maxing out, and they immediately protected their capital.
Now for the most important part. Section 5. Gross Adjusted Position Sizing.
This is the climax of our explainer today. I am handing you the hard, actionable rules for protecting your book. From now on, I want you dictating your risk management strictly by these parameters. If GEI is above the 90th percentile, you reduce your position size by 25%. The market is just too structurally fragile. If GEI drops below the 20th percentile, reduce your size by 50%, simply because engagement is too low. If you find yourself in a Quadrant 2 powder keg, you cut your size by 25% and you use wider stops. And if you're stuck in a Quadrant 4 great unwind, no new positions, period. You adjust based strictly on these gross market conditions, no exceptions.
Now, when conditions are actually right to trade, here's how we go on the offensive. This is the gross squeeze setup. It's how you inflict maximum pain in the breakout direction once that internal conflict finally resolves. Step 1, identify a GEI above the 90th percentile with a divergence reading near 0.5. Step 2, place entry orders on both sides of the recent range. Step 3, you enter aggressively on a volume breakout and you stop out on the opposite side. Because when that powder keg finally blows, the losing side is forced to capitulate and the move is explosive. That, ladies and gentlemen, is exactly how you pay for your year-end bonuses.
I want you to keep this principle front and center on your screens every single day. The shadow tells you the direction, the substance tells you the force. That net position you've been relying on all these years, it's merely a shadow. It's an illusion. It's the gross position analysis that reveals the true structural substance of the market. It shows you the actual, unvarnished force behind those numbers.
Which leaves us with one final, very real question for everyone on this desk. Are you going to keep trading the shadow, or are you ready to master the substance? It is time to step up and integrate gross long and short analysis into your daily trading decisions moving forward. Survive the hidden risks and capitalize on the true structure of the market. All right, let's get to work.